We're back again with another fantastic interview and great guest. Today, we have Sam Ger, who is the CIO of Monarch Asset Management, joining us to go down a road talking about all the new things happening in crypto with DATs, some of the strategies that they're running, and I'll let him get into all the fun stuff. So, Sam, thank you for joining us.
Oh, thanks, Jake. It's great to be here. Finally, we've rescheduled a couple of times, so I'm glad that I'm glad that I'm here. Um,
Okay, what's up, great?
yeah. So let me just a note, about my background.
Yeah, would love to hear. I think the audience, just kind of set the scene for who you are, where you've been, where you're going. I think that'd be really helpful.
Awesome. So at the highest level, I've got 35 years of experience across all asset classes. 35 years is probably older than most people in the audience. So I like to say I'm a crypto. I'm
You'd be
crypto.
surprised. Our demographic tends to be between 40 and 70 that watches.
Well then they'll love this because I refer to myself as a crypto OG because I've been investing in crypto since 2018. But the OG stands for old guy. So which I'm still getting used to being the old. I was always the youngest guy. Anyway, I've got 35 years experience across all asset classes, and my career is really punctuated by leadership experience during paradigm shifts in the industry. I've been a C-level executive in iconic public and private companies. I've led investments, IPOs, and M&A ranging from early stage deals to multi-billion dollar merger. I've traded, created, or managed products in almost every corner of the financial universe. And I started investing, as I mentioned, in crypto in 2018, recognizing this as a generational opportunity. Currently, I'm, as you mentioned, the CIO of Monarch Management, where I run our systematic long-short strategy. My work here has really been about applying institutional risk management and systematic frameworks to this new asset class to attract institutional investors to a directional product that they can understand and is properly risk managed. Previously, I was at Block Tower, where I ran the firm's long bias flagship fund as co-PM with one of the founders. And before that, I founded and ran my own hedge fund. It was called Katana Financial, no relation to Katana Crypto. And Katana was a major systematic VIX trader, started out as a VIX trader anyway, accounting for up to about 10% on good day of daily VIX futures global volume. When in 2018, we dipped our toe in and became one of the first market makers of the CME, Ethereum, and Bitcoin products, mainly because I was able to arbitrage it between the Bitcoin, between the SIBO product and the CME product. As I like to say, the dumbest trades take the most money, right? The most time.
Get inefficiencies, right?
Exactly. So in 2000, and so I geared my, and so like I geared my career to this because I saw firsthand what a game changer digital assets could be. I really started digging into it, understanding it. I read the Bitcoin white paper. I was fascinated by it, and boom, I was hooked. I got the bug. Some notable positions I've held. I was CIO at FINRA, where I oversaw technology for the world's largest regulator. Fun fact, they are one of the world's largest data processors in terms of the amount of trades and transactions they do on a daily basis. They didn't know this before I got there, but they process twice as many transactions on a daily basis than MasterCard and Visa. I managed there. I managed and right-sized a tech organization of about 3,000 people, including consultants. And before that, I was the CIO, Chief Information Officer at NYMEX, where I led the transition from open outcry to electronic trading. Right, a paradigm shift in the industry, which I still have the battle scars from, and I kind of use them every day in my newfound career here. And I also served as CEO of NYMEX Europe, lived in London for 2 years, learned how to speak British. And no offense to the British folks out there, but they know exactly what I'm talking about. And then I returned as EVP COO at NYMEX, where I led the deal team, making strategic investments ranging from $25 million to $100 million, to take minority stakes in different exchanges and technologies, as well as culminating in the $9 billion merger, landmark merger, I should say, with CME, where CME acquired NYMEX. Fun fact about that is Had a change in control in my contract at the time, and I had a bunch of unvested options that became vested, and I got to sell all of my options 2 weeks before Lehman Brothers occurred. So uh, it's another thing we used to like to say on the floor at NYMEX is I'd rather be lucky than smart. So
Sounds like you called it perfect timing on that one.
yeah.
Um,
And so here I am. Look, I've focused on being part of the crypto community in the crypto world after I mentioned recognizing this is a generational opportunity, a generational shift in market structure. And in 2024, I committed fully when I had my, I guess now quasi famous Cortez moment, because I've been quoted as saying this, where I burned my boats when Cortez the explorer came to the New World. The first order he gave to his men was burn the boats to signal they've got to make it work and there's no way back. I sold my software to a high frequency firm in Chicago, the software that powered Katana for all of those years, and just went full bore into crypto, recognizing this recognizing that the decision makers in the next decade are going to be a generation that's very comfortable with virtual payments and cryptocurrency. In fact, many in the audience, well, maybe below the demographic, but many have never known a world without the internet and certainly without Bitcoin. So and I take this from experience with my kids. I have kids who are in their 20s, and all of them and their friends are very comfortable with using payment apps like Venmo. Nobody carries cash. And as the generation ages into the decision makers, because that's what they're going to do. That's what happens, right? You'd be foolish not to think this is the future. So it's adapt or die time.
yeah, I completely agree with you. I think there's a huge opportunity right now for people that are building infrastructure and see the opportunity to take advantage of it. Um, right here on the precipice of clarity for a lot of this stuff that I think we're going to get in early 26. And the people that made bets, about the same time that you did, before Trump actually, got into office and we had bipartisan support for this asset class. I think they've seen a really good 2025 and will see, the rest of the decade through a very strong upward momentum. Um, so, the first time I ever saw you speak was just earlier this year at Coin Alts, and you were talking about a plethora of things, but you were coined up there for talking about DAT 2.0. So, I kind of want to take the conversation that direction. What do you think DAT 1.0 was, and where do you think we're going with these structured products and companies listed on
Yeah.
exchanges?
So I think we should really, zoom out and say, and discuss why do we think DATs are important, right? Because they're extremely important, although they really are like the redheaded stepchildren of crypto right now, and even the equity markets, right? I mean, they're just being beat up every single day, and most of them, I'm just saying, deservedly so. Um, so that's are really important because they broaden access to the asset class. And they're a managed vehicle akin to a closed fund rather than a passive vehicle. So if you want to buy Bitcoin and just be exposed to 100% of Bitcoin's beta, go buy the ETF. It's nice, it's safe, it's cheap, or it's safer, I should say. um, Crypto is a hyper volatile asset class. And by the way, I'm required to say this is not investment advice. Um, but DACs are important because they're broadening access to the asset class for people who don't want or can't have access to crypto rails. So they don't want to set up a Coinbase account. They don't want a wallet. They don't want to manage keys or anything like that. Think about the dentist in Oklahoma. Think about a university endowment who needs to get their investment charter just completely redone. Well, they don't have to do that now. If they want exposure to a managed vehicle in Ethereum, go out and buy Bitminer, right? Or if you want to, they buy into Michael Saylor. So on a good day, if you buy into Michael Saylor, then go buy MicroStrategy, right? Or buy some of the preferreds, etc. There's a whole plethora of these new products out there that are being innovated on and are being offered. Now, the problem is, as with any, as with any new product, there was a lot of fluff around it, a lot of fluff, a lot of FUD as well. And a lot of projects in what I call DAT 1.0 were rushed to market. So DAT 1.0, as I call it, was all about, you heard a lot this year about the fictional, as I say, the fictional MNAV. I called MNAV a fiction earlier in the year, way before the CoinAlts conference, and almost got tarred and feathered and taken out of a conference by the believers, if you will. And so, as in my former career as an arbitrage trader, I would call MNAV arbitrage bait. If you're telling me that I can sell you $2, I can sell you $1 worth of Bitcoin for $2, I'll do that trade all day long, right? And so that's exactly what happened. It just took a while. And so most of these companies, though, bought into this dogma of going out into the market and quoting the flywheel, where they were using an ATM and at the money secondary facility where they were able to sell shares pretty much on demand. And so it kind of went like this: if the market goes up and your shares go up, and they're trading at a premium to NAV, you sell more shares and then you buy more tokens, and then the price keeps going up, your NAV keeps going up, and everything's good. The problem, Jake, is, as we know, markets tend, sometimes they go down. They do. And when you're and failure to have a plan, failure plan is failure to have a plan. I think I probably
Yeah.
angled that one, but but most of these DAX did not have a plan for when the market went down. They went out, they spent all of their cash on the first weekend, telegraphed it to the market that, hey, we're going to go out and buy $500 million worth of X, Y, and Z, whatever it was, Solana, Ethereum, etc. The market, like participants like us, would just take the opposite side of it. We knew once they were done, they were done. And then they basically pinned their hopes and dreams on a continuing upcycle. Well, as I said, markets go down. And so you see now a lot of companies that have been compressed, right? They've been compressed because investors bought at multiples of NAV. So they bought at like a 2.0, two times the NAV. The base asset went down and the NAV collapsed, right? So it's just kind of double whammy now as an investor. And what you've seen is people just exiting these trades and saying, we're done, we're out of here. And this really happened, honestly. And everybody knows me as a straight shooter, so I'm going to be really, really straight. These were projects that were rushed to markets. They did not realize that these are trad buy products. They put people into management teams who had zero experience running traditional finance or publicly traded companies. And then at the same time, they had flawed business plans and a capital stack that had converts or sometimes warrants that were highly dilutive, and sometimes debt service that's hard to pay. Well, it's pretty predictable what that outcome is going to be, right? When the market goes down, it's like Warren Buffett says, when the tide goes out, you see who's swimming naked. Well, we're on it. We're on a nudist beach right now. So, so now you have companies who are going out and selling their base asset. You have Ethereum companies going out and selling their base asset to raise cash to buy back their stock because they're trading at a discount. But then aren't they just negating the exact purpose for which they were created, to be a treasury of Ethereum or Solana or XYZ? So that stuff doesn't work. So I really started thinking a couple of months ago about, and I coined DAT 2.0 a couple of months ago, because really, what's the purpose here? The purpose, or the purpose should be, is to create a treasury that you can manage, that you can create yield from, and that you can increase shareholder value with, right? And so there's a couple of core tenets to this DAT 2.0 concept. The main theme is that you want to increase the number of tokens per share. That's your reason for being. Your whole drive, everything that you should be doing as a DAT 2.0 company is to be increasing the number of tokens per share or decreasing the number of shares, the numerator or the denominator. So a couple of things. We always want to have cash on hand, dry powder, as I call it. When I operate my hedge fund, and even at Monarch, I like to have a significant amount of dry powder because, in general, 90% of the alpha is made in about 10% of the time. Think about market spikes, market dumps, corrections, events. Think about Fed decisions, etc. If you've got dry powder and your position and you're not completely maxed out, you can take advantage of dislocations. Well, same thing with DAT 2.0. Have cash on hand, go and buy your tokens selectively. Secondly, you want to sell your stock when NAV is above 1.0 because that's an arbitrage to you. That's when you want to use your ATM to sell stock, to generate cash, and then buy tokens well, selectively, right? You don't have to tell the market. You don't have to have a plan or a program. You just go out and buy selectively and utilize the experience. Hopefully, the team has some experience in markets. Use the experience to do so. And then the third piece is when the NAB dips below, let's call it zero point 0.9, zero point 0.8, maybe 0.7, whatever target you want to set, take your dry powder and buy your stock back, thereby decreasing the denominator, thereby increasing the number of tokens per share. When you increase the number of tokens per share, by definition, you're increasing the book value of every share of stock. Pretty simple. You want to take, and at the same time, you do your daily operations and operate as a publicly traded company. Take your stock, invest in staking. Take your tokens, invest in staking, invest in builders, be part of an ecosystem. Which again, if you remember in coin alts, I was really talking a lot about hype at the time, and I'm still a big believer in hype and their ecosystem and what they're doing right now because you can take your tokens, stake them, earn yield, be part of an ecosystem, just be part of a token that's got decreasing supply. Just today, they burned 11% of their supply. Nobody noticed, I think. But this is what you should be doing as an operator, as a seasoned operator in the public markets.
So, perpetual futures is a big thing, and hype has done fantastic with that. So, we haven't talked about hype on my channel at all. We primarily focus on, some of the other assets that are out there, and hype's new, right? So we've seen this probably in the last, maybe they've been around 2 years, but they have the strongest perpetual futures marketplace on chain.
Yes.
And then they generate a lot of money from the trading fees in that marketplace. And then they use that cash that they're getting to buy back their token, which, then they burn the supply and it drives the supply down and demand goes up. What do you think they're going to be doing over the next 12, 24 months to continue to drive demand for the token? That's the only thing that's still missing for me. Like the staking component's awesome. Do you think you'll get advantages? So like Nexo and some of these other platforms incentivize people to hold their issued token and they get discounts or benefits for, participating in their ecosystem. Have you talked with them to see what's on the roadmap for, how they're going to continue to support demand for the token over the long term?
Yeah, I mean, we've spoken with them. But they're actually doing this right now.
Okay.
So they've come out with an incentive. I'm sorry, a protocol called HIP 3. And I don't know if you've seen this before or not, but HIP 3 basically allows anybody. This is also revolutionary, Jake. Right? Allows anybody to go out, stake 500,000 hype tokens, which there's a demand creator right there. But if you stake 500,000 hype tokens, you can create your own perpetual exchange. So right now I think we're pushing about half a dozen of these in the last month. It's only a month old. The biggest of which is Trade XYZ. They created their own perpetual exchange just by staking 500,000 hype. It's on a permissionless basis. You choose your oracle. You choose the contracts that you want to list. You get to use Hyperliquid's infrastructure, their front end, their distribution, their risk management, their margining engine, and you don't have to build any of this. Now, as somebody who's built exchanges before, I would tell you that it is well worth the 500,000 tokens to do this. On top of that, what Trade XYZ has done is they've listed about sorry about that. They've listed about a dozen different perpetual equity futures based on United States Nasdaq listed equities. So there's on-chain trading of equities happening right now on hyperliquid trade XYZ in the form of perpetual futures, which is massive if you're somebody outside of the United States who doesn't have a Charles Schwab account, or your broker wherever you are, whatever country that you reside in, doesn't have access to US markets, or for whatever reason you don't have access to US markets. You can now trade equities on Nvidia, Apple, Tesla, the QQQ. It is a phenomenal achievement. And people are lining up to do this. I think Kinetic, which is one of the big validators, they just started their own. Athena started one called Hyena. Um, it is, uh, I think what you saw, or what you're seeing right now, is hype has gone from taking the world of perpetual futures by storm with a really innovative and unique model, giving a CeFi experience in a DeFi wrapper, which is, what did they do really well? Two things. One, they gave you a really slick, easy to use user interface. They got the interface down, and they got it down correctly. But two, more importantly, it's on a permissionless basis. You connect a MetaMask wallet, you're in, you're done. That's it. So, um, so they're going from that model where they captured, I think, 20-25% of the marketplace in perpetual futures and open interest, and they're still the leader in open interest despite other competitors who essentially have very high wash trading ratios. They're still the leader there. They're pivoting to a builder model.
Well, they'll become a platform.
Exactly. The
So
builder.
that's the deal, right? If you can become the infrastructure layer and everybody builds on top of you, we saw this with Ethereum, right? Like the proliferation of smart contracts and layer twos on top of the
Precisely.
Ethereum network, and then Solana with all of the meme coins and all of the volume that happened there. Yeah, that's incredible. So I knew that there was going to be something else that they were going to do to drive and cultivate demand for the token, to continue to push the liquidity in the ecosystem up. But that makes a lot of sense. I think that that's actually so. On that though, with the regulations in the U.S. around perpetual futures, do you need to be a broker dealer or have some other licenses in order to be able to operate a decentralized exchange for futures in that capacity, or is it just the proliferation of this is currently happening offshore?
It's currently happening offshore.
Okay.
I would imagine that's going to change in the near future. What I foresee is, especially with hopefully in the Clarity Act, we'll get some clarity on being able to trade on overseas exchanges. And my guess is, if you read the tea leaves around the Binances of the world and some of the investments being made in that ecosystem, I think that that's going to come to pass. And then it'll be wide open. But currently, if you want to open up an exchange, I don't think you can do that from inside the US just for regulatory purposes.
Yeah, I figured as much. The SEC started to come out the other day and give some guidance around broker dealers' participation in the space, and they've started to give real, actual guidance on what to do here, which has been lacking for the last 4 years in the previous administration. Really excited about Paul and what he's doing over there. So, um, kind of back to the DAT component, you mentioned different yield type products or different ways to generate additional return on the asset for that cash position, be able to buy back the stock when it's below MNAV, right? So, what are you seeing out in the market when it comes to that aspect? Obviously, they're staking, but that's in kind returns. What are you seeing out in the market for people to be able to generate cash off of their assets? How are they leveraging those?
Yeah, so we're talking about things where you want to keep custody of the asset, not lose custody of the asset, but
Right.
still
We don't want that counterparty risk. Yeah.
Yeah. So, we do a lot of that at Monarch right now. We have a pretty thriving business for DATs where right now we're managing capital, or have been selected as the asset manager for about half a dozen of these, with an asset platform when all said and done is going to be close to $1 billion. And we do this. Remember, if you're a DAT, you have to keep custody of the core asset. And so we do this in a way where we'll borrow against that asset and choose our counterparties very wisely, and create a custom risk overlay or risk adjusted return matrix for the particular debt. And we essentially have three levers that we can move up and down to kind of create the profile for this. and just picture in your mind three levers. One is expected value, one is your counterparty risk, and one is duration. So when you move each one of these levers up and down, you create this kind of custom blended tranche or a bunch of different tranches of of income producing or yield generation that becomes attractive and customizable. So we do this with we will generally borrow against the core asset and then lever that depending on those requirements.
Yeah, that makes sense. So you kind of get like a line of margin against it. Um, and then, you're ideally reflecting that off of exchange. So you're holding that in institutional custody and reflecting that value somewhere else.
Precisely.
Yeah, we do that, for our clients and the structured products that we've created. And it sounds like market neutral strategies is kind of the bread and butter that you guys have as well. You want a high Sharpe ratio, like you talked about. So, like, what are you seeing out of the market for appetite from DATs? If you had a DAT and you were looking for something, obviously you have a strategy that you've curated for that. But in your mind, what does that look like?
You want specific tokens or you just want a high level?
Let's say, so there's a ton DAT, right? Well, so we'll just take that one as an example. You've got ton. They've raised a bunch of money. They've taken on some debt. They've got to service that. Let's call it 2 or 3% interest. It's low interest. So they're able to put it to work, maybe margining it and putting in a laddered treasury strategy or something to generate just above what they need to make sure that they're servicing the debt, to have some excess cash to buy back their stock. You think people are going to be more aggressive than laddered treasuries or mutual funds? Like you mentioned duration in there too. I'm good. I don't know what all the products are that are out there and available at this point for that type of exposure for these companies.
Right. So some of the products would be OTC, one to one, peer to peer sort of product, a bilateral basis. Some of the products are on exchange, and some of the products are DeFi. But duration specifically goes towards what the anticipated cash needs of the DAT are. And so some may take a tranche and they might want to be more aggressive with it to generate maybe some near term returns. I think that if I were running a DAT right now and it were this ton DAT that you're talking about, and I did have a bunch of cash, I would be doing exactly what the DAT 2.0 model I described is I would be waiting for it to be trading at a fairly significant but not crazy low discount, because you get to the crazy low piece and then the market loses confidence, right? This is where experience of running a publicly traded company, speaking to analysts, speaking to investors, understanding what investors want, etc. This is where that comes in. So I would be targeting what's called a point 0.7 or point 0.8 NAV, and I'd be buying my stock back if it's going that low. Remember that a DAT has two components to its value, if you will. It's the beta, which is how do I track the core asset. Now, remember, a lot of these DATs do have some convertible or excess or some unexercised warrants that are out there, and that contributes to what what your fully diluted NAV can be. So from that aspect, I would be looking to buy more ton as it moves lower, increasing the number of tokens per share that way, and also buying back my stock.
Yeah, I think that's a brilliant. But is there a native staking mechanism for ton? Okay.
Not I would actually have to. I don't have experience in doing that, and so I'm not ashamed to admit that. But my managing partner Shiliang Tang uh, is really well versed in this, and I know that we're doing something with Ton right now.
There you go. So anyway, yeah, there's going to be a bunch of these assets that don't have native DeFi components that allow you to generate return with them, and you're going to have to get creative in some way to be able to leverage that.
Yeah,
Uh,
Bitcoin's a prime example, right?
exactly.
Or even Ripple is a prime example, right?
Excellent.
So yeah, so how I would approach that is I would borrow again. I would borrow against whatever token it is, Ripple or
Mhm.
Bitcoin or Bitcoin. I would borrow against it, and then I would move into a DeFi mechanism and or potential. There are some really good options markets out there in terms of peer to peer. Think about a Falcon X who, full disclosure, owns the majority of the Monarch GP. So shameless plug for Falcon X, but I would go to Falcon X's desk and say, okay, I want to create an options box around this particular asset that will either give me a range, and I'll collar it, or I'll create a box which will give me income around a risk free rate, or maybe even higher. Or I want to say, okay, on a range based note, I'm going to take this I borrowed a stable coin, and I'm going to now take this and stake it and or create and or maybe buy more Bitcoin or buy some ETH and then stake it.
Do you think many people will be doing like tokenized money markets like they have for VanEck? VanEck just rolled that out, 6%. So you borrow here and then put it to work there and you're generating, some upside.
So yeah,
Um, yeah.
yeah. So this goes into institutional adoption, right? So I mean, this is a prime use case because now you have competition amongst institutions to start launching some of these money market funds and generate above, I don't know, the 0.5% that you get in a savings account or whatever you get right now, right? And people are waking up to this. They're saying, hey, now through an institution, I don't have to have a crypto account, right? I don't have to have a Coinbase account. I don't have to have a Kraken account. I can just go to my Charles Schwab account and buy into this money market fund and generate 6 or 8% yields. Transformational.
Yeah. Well, you can loop it too, right? Like, so that's the other thing that'll be, you never know when you're taking leverage on stuff and say you're
Yeah.
using the
Yeah.
Bitcoin or whatever else, if there's volatility in the market and you haven't accounted for that. The other strategy that I've seen some people use, and I'd be interested to get your thoughts on this, selling puts below, the current value, right? So you've got cash on the side, you're going to sell puts with the asset that you have. And then if there's a call, you are required to buy the asset that you're selling the puts against anyway.
Right.
So you're generating cash flow and accomplishing, what the DAT's supposed to be doing. Um, I think that they're probably already employing that strategy. But
Absolutely. Yeah, I mean, Metaplanet is known for doing this, right? Metaplanet is one of the largest Bitcoin call overwriters in the marketplace. I'm almost 100% sure they're selling puts too. Why not? It's for them. That's a really good use case, right? For an individual investor, people have gotten carried out selling puts, right? Because you also get carried away.
yeah,
So you sell them, it's easy money, you get a great expiration, you're like, "Wow, this is like printing money," until it's not,
yeah.
right?
Until you get that call, you got to cover.
Right, and so you have anytime if you're selling that put naked, look, you've gotta you this is all about risk management. How do you price risk? What's your expected value of the trade? So if you're selling those puts, you're selling them naked, that's fine as long as you're like, "Hey, it's okay because I want to buy that particular asset at that particular price, and there can't be spilled milk." If you're selling $90,000 calls when it's trading 120,000 and now we're trading 80,000, well, you're long at 90,000, but hopefully, you sold them far enough out that you got some stock value on that. It just a footnote, I mean, that literally happened to me in TradFi. I had, in my personal account for years, I just had a put selling overlay, and I remember I sold NVIDIA puts, $430 puts, and NVIDIA went to, like, 190 on me, and I'm just like, "Well, I guess I own some NVIDIA," and it turned out to be a pretty good trade, right?
Yeah, I think that worked out for you.
Pre-split, pre-split, so
Oh, wow. You did great there.
yeah.
Well, this has been awesome. I love the conversation. Excited about DAT 2.0 and where the industry's headed. Where do you think we're headed in 2026? Like, if you could, rub your crystal ball and see what the market looks like over the next 6 to 12 months. Any, staunch predictions that you have for the next year?
Yeah, I mean, it's no secret. I've always been, I will be. I'm continuing to be a bull in this marketplace, even now. Although my prediction for higher end of year did not come, but at the same time, my whole portfolio, our portfolio of Monarch was completely hedged to the downside. And we actually went to cash on December 1st. So, not a bad year for our directional fund. That being that as it may, at a high level, right? What's changed? Nothing. Nothing's changed. Institutional adoption is soaring. We've got regulatory tailwinds and a friendly regulatory environment that we've never had before. The macroeconomic story, the case for owning a permissionless, decentralized, fixed supply asset is, I mean, more than ever right now is still there. And I do think that specifically the Genius Act is really going to propel crypto in the future, digital assets, specifically Bitcoin and Ethereum. And I buy completely into Tom Lee. Might not buy into Tom's actual numerical predictions, but I buy into his narrative that we are having this. And I'll expand. He likes to say that Ethereum is having his 1971 moment. I think that digital assets are having a 1971.
Yeah, I would agree with that. I think there's going to be a gigantic shift in this market as we see institutional adoption, and the liquidity floodgates are going to open at some point in the very near future.
The demand is there. And the supply is now digital asset treasury vehicles are holding supply. You've got MicroStrategy holding supply. You've got over 100 corporations that have Bitcoin on their balance sheet, and that's only going to grow. I can't imagine that institutions that missed the entire up move aren't saying to themselves, "Hey, this is a great time to get in for all the reasons that I just mentioned." And then we're also talking about the transformational shift that's about to occur and is occurring in financial markets right now, and the adoption of on-chain technology. Just a footnote, I'm sure you saw the recent investment in Canton Networks, right?
I did.
So for your audience's edification, recently Canton Networks, which is an RWA tokenizing platform, for lack of a better word, did a capital raise of about $130 million. Leading the raise were the two largest market makers in equities in the U.S. and in the world, which are Citadel and Virtu. Hidden in the list of investors was DTCC.
Yeah.
DTCC is the Depository Trust Clearing Corporation, which is the centralized clearinghouse for all equities and fixed income in the U.S. and the largest in the world. DTCC has had a digital ledger technology project on its books since 2019, has not made any traction. But read between the tea leaves. If you look at crypto conferences and people who attend, etc., DTCC has mysteriously been showing up lately and speaking, etc. My prediction is that you're going to see within 18 to 24 months at the outset, U.S. equities, actual U.S. equities, not perps, but equities being traded and cleared on chain.
Yeah.
Which is going to be just an absolute boom for stable coins. Will be an absolute boom for ETH. And then by definition, everything else is going to float, and Bitcoin as well.
Yeah. I think we're right on the precipice of, so when I was at Swell, Monica Long interviewed the president of NASDAQ, and she was talking about back-end settlement and reconciliation of the stock market being on chain. And that was kind of be the first application of distributed ledger technology before they tokenized the broader stock market in later 26. So I think you're 100% spot on.
As someone who's on the inside, the only thing that's holding that up right now, it's not even regulation that holds that up, but most banks, obviously banks don't want to do it, right? Because
they're part
of their mojo, but also they're all banks as well as service providers are still working on TradFi rails from the 90s. A lot of these systems are still from the 90s and can't handle 7-day. They can't handle real-time margining. They can't handle real-time capital calls, etc. So it's going to be interesting.
Yeah, be a wild ride in 20.
There's a lot of room for innovation. That's all I know.
Well, if somebody's interested in your fund or wants to learn more about what you guys offer over there, what's the best way for them to reach you?
They can reach us either on our website, www.monarch-am.com, or they can send an email to our head of BD, William Purdy, william@monarch-am.com.
There you go. Well, we'll have the links for it in the show notes below.
Awesome.
Thank you again for taking the time out and giving us the education on DATs and what you guys are doing over there. And wish you guys the best of luck in
Oh, it's been my pleasure. Absolute thrilled to meet you, Jake, and really look forward to meeting in person at the next time that we're jabbering away at one of these conferences.
It's going to be great.